Hello and welcome to another Macro Monday. My name's James Brodie and today we'll be discussing the busy week ahead. We have the Federal Reserve meeting, we have US employment data, but to start with we'll discuss last week's mixed economic data. Firstly, in the US we had weak PMI data, Purchasing Managers Index, with both service and manufacturing sectors came in below expectations. But the big data was on Thursday, GDP. GDP for Q1 2024, it's backward-looking data, so normally it doesn't get too much attention. It was expected to come in up 2.5%, but it came in really low at just 1.6%. Again, way lower than expectations, but also far lower than Q4 of last year, which was 3.5%. Not only was this data weak, which should have been concern to the Federal Reserve, but what was a double kicker for them was the inflation component. PCE price index was expected to come in up 3.4%, jumped to 3.7%. You started to see volatility pick up in the markets, the typical risk-off situation where equities started to fall, gold started to rise, and actually in this case, yields continued backing up higher, the market pricing less chance of Fed price cuts this year. This data was compounded on Friday when we had the PCE, Personal Consumption Expenditure data, one of the Fed's favourite inflation metrics, coming in slightly above expectations. But the concerning part of that was the 3-month annualised change in core PCE is up to 4.4%. This is clearly moving in the wrong direction. So for the US, the economic data was weaker, but the inflation data was higher. Absolute worst case scenario for the central bank. So you're starting to hear people talk about the dreaded stagflation whispers again. Outside of the US, we had some slightly stronger data in Germany. IFO business expectations came in at 1-year highs. Of course, we've talked about how weak Europe and especially Germany had been. So this was good news for the ECB. Also, Australian CPI came in above expectations. Here, the market had been discussing rate cuts in Australia. All of a sudden, the market's almost completely taken that out. There's only 9.5 basis points of cuts priced in the OIS market, overnight index swap in Australia this year. The trimmed mean, which is what the Reserve Bank of Australia focus on, has suddenly ticked up. Expected to come in up 0.8% quarter on quarter. It jumped to 1% and is now at 4% year on year. So the OIS pricing, the market's now looking for only 35 basis points of cuts by the Federal Reserve this year. This is interesting because we have the Fed meeting this week. The Fed members in their dot plots have estimated that they will need to cut 3 times this year. The market is only pricing 1 full cut. So it'll be interesting to see what the Fed does. We're not expecting a move this week, of course, but the market will focus on Chairman Powell's speech for any hint in change of rhetoric to becoming more hawkish. The ECB, on the other hand, the market is pricing 70 basis points of cuts, and the market is pricing 92% chance that they do their first full cut at the 6th of June meeting. The RBA, as I say, has nearly completely eradicated price cuts, only 9.5 basis points of cuts this year. And the Bank of Japan, of course, the market is looking for hikes, 20 basis points priced in there. One country we haven't mentioned recently, but it's worth bringing up because we had some very strong data last week, is India, now the 5th biggest economy in the world by GDP. Last week, their manufacturing PMI reached a 16-year high of 59.1. Huge expansion. The country has very strong demographics. Credit card users have doubled in the last 4 years from 47 million to 95 million. Also, stock trading accounts have trebled in the last 4 years as well. We're seeing strong growth in India, strong demographics as well. The dollar continues to be strong. Hedge funds and money managers are the most bullish they've been on the US dollar in the last 5 years. And we now have a record short position in the yen. Today, this morning, we've seen a really volatile start to the week in Japan. It's not been confirmed if it's intervention by the MOF yet, but we've seen huge swings. Dollar yen range today has gone up to 160.2, down to 154.5. That's a 570 basis point range. Huge swings. Again, huge long position in dollar yen. And it'll be interesting to see how this plays out as the market starts to move against such a strong concentrated position. We're also hearing more discussions regarding Chinese yuan devaluation. China's been importing huge amounts and storing commodities, and it will be interesting to see if this is a prelude to the currency devaluation and all the problems around potential trade wars this would have as they export deflation to the rest of the world. Equities, we have a big week. Over 20% of S&P companies are reporting. And again, we have extreme positioning. Asset managers are more bullish on US stocks than at any level seen over the last decade. Last week, we had a raft of earnings as well. Meta beat expectations, but the stock closed down 10%. But more interesting one was Tesla. And this is a really good lesson in positioning. Going into Tesla earnings, the market was 52.5% off its 2023 high. It'd been going down for 7 consecutive days. Poor earnings came out, and also the company announced negative free cash flow of $2.5 billion. This was really bad. The market was expecting positive free cash flow of $653 million. All this bad news, but the stock jumped 12%. When everybody is short and the market can't go down on bad news, stops get triggered and you get these aggressive moves higher. This is why I keep pointing out when we get such concentrated positioning in markets. It typically happens as volatility goes down, and the moment volatility picks up, positions get wiped out. So looking at the S&P this week, you can see the last 3 weeks, we had a pullback from the huge aggressive run higher. We have a clear double top at 5,261. The market's pulled down to 4,953 and has bounced in the last week. Where this becomes really interesting is from a technical analysis and positioning perspective. The longs need to break new all-time highs to get strength back. But if the 4,953 low of last week gets broken, you will see a raft of stop loss selling. So key levels in the S&P, 5,261 and 4,953. On to precious metals. We mentioned last week that China's central bank had been buying gold for a record 17 consecutive months. But what we're now seeing is Chinese retail traders aggressively buying. Here we can see the chart, Chinese gold trading activity exploding on the Shanghai Futures Exchange. Something's very interesting with retail trading in China is they are far more aggressive in their trading than in certainly Europe and also the US. The other thing is retail traders will aggressively trade commodities. A good example is back in 2016. In March to May, iron ore and cotton prices nearly doubled. That's not the interesting bit. What's more fascinating is that volumes went up 30-fold. On just one exchange, on just the Dalian exchange, at the peak, the daily futures volume in iron ore equaled China's annual imports. And on just one day, the daily futures volume on cotton was enough cotton to make a pair of jeans for everybody on the planet. But what's different this time is then the Chinese retail traders were actively trading. Now it looks like much longer term investment. In China, people have over 70% of their wealth in property, and property's been falling for over a year and a half now. So now it looks like people are moving their portfolios into a more safe haven they're regarding as gold. So this is not, in my view, a shorter term trade, but much more of a longer term investment. And so in my view, that gives this move much more legs. If we bring up the chart again, you can see how gold broke through the quadruple top at 2080 at the beginning of the year. And similar to the S&P, in the last 2 weeks, we've seen a sell-off and a bounce, which means we have clear critical levels. The bulls need gold to break above 2,430 to continue the bull run higher. But if it breaks through last week's low of 2,291, then stops will get triggered and we will have a short, quick move lower. It will be interesting to see how this move plays out in the weeks ahead. But it's something we've highlighted when we discussed the fact that equity markets have clearly stalled in their longer term move higher, and we can see money moving into commodities. The commitment of traders data shows that net longs in silver is at 24-month highs, and net longs in copper is now at 30-month highs. Copper, another commodity where we've seen a huge aggressive run higher in the last few weeks. So on to employment data. On Friday, first Friday of the month, we have US payrolls. Typically now seen as probably the most important economic number out there. CPI has fallen, obviously, from the peak in 2022. It's still above target, but now the market's more focused on employment. And this is what kept the Fed from being more dovish in the fourth quarter of last year. We're seeing consistently strong payrolls, averaging about 250,000 new jobs created each month. Unemployment is at 3.8%, just ticked up from the cycle lows of 3.4%, but this is still incredibly tight. We have seen some underlying weakness in the data though. Supply of data is falling. We've seen that from the JOLTS index, and we've seen demand from small businesses, which make up 70% of the economy, declining. But we still keep seeing positive prints. Last month, payrolls came in up 303,000. What we are seeing though is the jobs that are being created are part-time jobs. Last month when the data came out, actually full-time jobs were lost. And if we look at data over the last year, in the last 12 months, 1.34 million full-time jobs have been lost. So although the employment data is strong, it's now increasingly part-time, and that is not a good sign for the economy. Friday's data, payrolls expected to add 250,000 jobs. Unemployment rate is expected to stay the same at 3.8%, and average hourly earnings are expected to increase at 0.3% month on month. When we do get a weaker payroll number, this will be incredibly volatile for the market. Bonds will aggressively rally and the market will suddenly start to price cuts again. I don't know when it will come, this month, next month. It's a binary outcome going into the data, whether it beats or comes in below expectations. But one thing's for sure, the month we do see a weak payrolls, we'll see aggressive volatility in the bond market. This will flow through then to, of course, FX, the dollar, and onto equities. An interesting chart I thought to highlight as well today is the US 2s 10s bond curve. It's been inverted since June 2022, nearly 2 years of inversion. The market has a double bottom at 108 basis points, and we're now trading at minus 34 basis points. What's interesting here is we're going into a week of certainly interest rate decisions and economic data. The market looks like it's consolidating before a breakout. It'll be interesting to see if the market can't price Fed hikes, then the front of the curve, the 2-year yield will fall, and this will almost certainly cause the curve to steepen. Also, there's concerns about US Treasury market sustainability. Janet Yellen issuing more and more treasuries. If there is fear and more treasury selling, then it's likely to be further down the curve. Another reason why the 2s 10s is more likely to steepen, in my view. So back to the week ahead. Key data, we have employment data on Friday, Federal Reserve meeting on Wednesday, over 20% of S&P companies reporting this week. We have US ISM data early this week, China's Purchasing Managers Index data out as well. 4 key charts I would keep an eye on: the US 2-year yield, dollar yen, particularly volatile today, the gold price, and the Nasdaq. Keep an eye on volatility. We have a fun week ahead. Thank you.